The echoes of 1929 continue to reverberate in the American economy as debt, speculation, and inequality once again challenge its foundations. The Great Depression demonstrated how fragile prosperity can crumble without oversight and social safeguards. A review of those bitter lessons reveals familiar warning signs today, reminding us that unregulated markets, delayed policy responses, and financial excesses can transform growth into a prolonged national crisis. Picture the 1,920 seconds, a decade that felt like one long, champagne-soaked rooftop party where the music was loud and the stocks only went up. People weren't just buying bread, they were buying dreams on margin, convinced that the American financial empire had finally figured out how to kill the business cycle. But beneath the flapper dresses and jazz, a massive asset bubble was expanding like a balloon in a needle factory. We love to think we're smarter now, with our high-frequency trading and digital wallets. But the ghost of 1,929 still haunts every Bloomberg terminal in Manhattan. The problem isn't just that the market crashed. It's that the entire monetary foundation turned out to be a house of cards, held together by hubris and bad math. When the ticker tape stopped screaming buy, the silence was deafening. This wasn't just a bad day at the office. It was the moment the world realized that infinite growth is a fairy tale we tell ourselves to ignore the structural risks hiding in plain sight. If you think your savings account is a fortress, 1,929 is the cold shower that reminds you that in a systemic collapse, even the gold under your mattress can't buy back a vanished civilization. To understand why the world fell apart, you have to look at the political and monetary context of the Roaring '20s. Post-World War I, the US was the world's shiny new creditor, strutting around with a pocket full of gold, while Europe looked like a poorly played game of Tetris. We were operating on a rigid gold standard, which sounds sophisticated and stable until you realize it's basically just anchoring your entire economy to a shiny yellow rock. Politicians at the time were obsessed with normalcy, a polite way of saying they wanted to ignore the fact that the financial market structure had become a giant casino. The Federal Reserve, still a bit of a teenager in the 1,920 seconds, was trying to balance domestic growth with global stability. But they were essentially flying a plane without a dashboard. There was this intoxicating belief that the US had reached a permanent plateau of prosperity. It's the same vibe you get today when people say, "This time is different," right before everything goes sideways. The political ego of the era demanded a strong dollar and a booming market, creating a pressure cooker where the economic fundamentals were being sacrificed for the sake of a really great headline. Let's get into the plumbing. The core monetary mechanism that turned a correction into a catastrophe. Back then, buying on margin was the original glitch in the matrix. You could put down just 10% of a stock's price and borrow the rest from your broker. It's like buying a Ferrari with a pocket full of nickels and a pinky promise. As long as prices went up, everyone was a genius. But this created a massive asset bubble fueled by credit that didn't actually exist. When the market dipped, the margin calls started. Suddenly, brokers wanted their money, and investors had to sell everything, including their safe assets, to cover the debt. This is the structural risk of leverage. It works beautifully until it doesn't, and then it works like a vacuum cleaner for your net worth. The Fed then made a classic oops move. They tightened the money supply when they should have loosened it, essentially sucking the oxygen out of a room that was already on fire. They were terrified of inflation, so they let the banking system collapse instead. It was a masterclass in how to turn a bad afternoon on Wall Street into a decade of standing in bread lines, proving that the mechanics of money are only as good as the people turning the wrenches. Power and politics are the ultimate toxic duo in monetary history. In the late 22nd, the motivation for political decisions was driven by a desperate need to maintain the empire image. President Hoover and his contemporaries weren't necessarily evil, they were just victims of their own rigid ideology. They believed the market would purge the rottenness out of the system, which is a very easy thing to say when you're not the one losing your farm. This wasn't just about economics. It was about maintaining the global demand for USD and the prestige of the American financial empire. There was a massive power struggle between the hard money crowd and those who saw the suffering on the ground. The fraud cases of the era weren't just shady guys in back alleys. They were the heads of major banks using depositors' money to bet on the very bubbles they were pumping. These captains of industry were motivated by the same thing that drives modern CEOs: the quarterly bonus and the status that comes with being the richest guy in the room. By the time the political class realized that the invisible hand of the market was actually a closed fist, it was too late. The ego of the elite had effectively bankrupted the future of the common man. The socioeconomic consequences were, to put it mildly, a vibe shift of apocalyptic proportions. Imagine waking up and realizing your wealth was just a shared hallucination. For the average person, the impact was visceral. 25% unemployment isn't just a statistic. It's the sound of a silent factory and the sight of a father selling his suit to buy milk. This is where the financial empire collapses part gets personal. When the banks closed, they didn't just take the excess money. They took the rent, the tuition, and the grocery funds. The middle class was effectively deleted overnight. People who had spent the 1,920 seconds feeling like pioneers of a new age were suddenly living in Hoovervilles, which were basically shanty towns, named after the guy they blamed for the mess. The sarcasm of the era was dark. People joked about the prosperity just around the corner, while they were literally sleeping on park benches. This period taught us that when the global demand for your currency or your debt falters, the first people to feel the cold are the ones who didn't even know they were in the room. It's a useful insight for today. Your digital balance is only as real as the social contract that supports it. And contracts can be torn up in a heartbeat. If you think 1,929 was a one-off, international history would like a word with you. It bears a striking resemblance to the 1,990 seconds Japanese lost decade or the 2008 global financial crisis. In every case, you have the same ingredients: a massive asset bubble, an explosion of private debt, and a government that thinks they can engineer their way out of a crash. The 1,920 seconds US was basically the pre-alpha version of every modern economic crisis. In Germany, the same era saw hyperinflation so bad that children played with stacks of cash like Lego bricks. The lesson from monetary history is that humans are remarkably consistent at being overconfident. We build these financial empires, convinced we've solved the problem of scarcity, only to find out we've just outsourced the risk to the future. Comparing 1,929 to today reveals some uncomfortable parallels: high wealth inequality, massive debt loads, and a stock market that often seems disconnected from the reality of people working 3 jobs. The 1,929 crash wasn't a uniquely American tragedy. It was a universal warning that when the economic fundamentals are replaced by speculation and vibes, the correction will be measured in human misery across every border. Section 7. Of course, there's always a counter-argument. Some economists will tell you that 1,929 was just a necessary correction that lasted too long because of bad policy, not a failure of the system itself. They'll argue that the gold standard wasn't the problem, but the abandonment of its rules was. This is the hard money perspective, the idea that if we just let the fire burn, the forest grows back stronger. It's a very chill and detached way of looking at a situation where people are starving. On the other side, you have the fans of the New Deal who argue that the government didn't spend enough, fast enough. This debate still rages on in every Federal Reserve meeting today. Are we printing too much or not providing enough liquidity? The sarcasm here is that both sides act like they're practicing a hard science when they're really just arguing over which flavor of magic will fix the broken wand. The useful insight for the audience is that nobody actually knows where the line is until we've already crossed it. These perspectives are often just sophisticated ways for people in power to justify their favorite brand of intervention, while the global demand for USD hangs in the balance of their experimental theories. As we zoom out, the big picture is both fascinating and terrifying. The echoes of 1929 aren't just historical footnotes. They are the rhythmic beating of a heart that is prone to cardiac arrest. We live in a world where the financial empire hasn't so much fixed the problems of 1929 as it has built bigger walls to hide them. Our modern market structure is infinitely more complex, but the human element, the greed, the fear, and the short-term thinking remains identical. We've replaced the shiny yellow rock with digital entries and faith and credit, which is basically a fancy way of saying, trust us. But trust is a fragile thing. When you look at the long-term risks today, you have to ask, have we actually learned the lessons from monetary history? Or have we just found more creative ways to hide the fraud? The 1929 crash was the end of an era of innocence for the American dollar. It was the moment we realized that being a superpower doesn't mean you're immune to gravity. As we navigate our own era of bubbles and unprecedented events, the open-ended question remains. Are we currently living in our own version of the Roaring '20s, blissfully unaware that the music is about to stop? Let's talk about the impact on a person's life in a way that isn't just depressing. The lesson of 1929 for the modern individual is about resilience and skepticism. In 1929, people believed the experts who told them the market was a one-way street to wealth. Today, we have finfluencers and talking heads doing the exact same thing. The useful insight here is that you are the only one truly responsible for your financial oxygen. When the asset bubbles pop, the people who sold you the dream are usually the first ones out the exit with their parachutes already deployed. Understanding the financial market structure isn't just for Wall Street guys. It's a survival skill. It's about recognizing when the economic fundamentals are being replaced by FOMO, fear of missing out. The 1920 seconds taught us that the most dangerous phrase in the English language is, "This time is different." If your strategy relies on the government never making a mistake or the market never having a bad decade, you're basically betting your life on a coin flip. The 1929 echoes are telling us to look at the structural risks in our own lives, our debt, our dependencies, and our assumptions before the echo becomes a deafening roar. We conclude this journey through the wreckage of the Great Depression with a bit of dark humor. We're still here, aren't we? The world didn't end in 1932, it just became much more expensive and complicated. The United States remains a financial empire. The dollar is still the king of the global demand, and we are still very good at blowing bubbles. But the lessons are always there, whispering from the dusty ledgers of 1929. We've learned to print our way out of problems, but that just creates a different kind of long-term risk. The final question for you, the viewer, is simple but haunting. If the system were to fail again, would you be the person dancing on the rooftop or the person who noticed the cracks in the foundation? We like to think we're the protagonists of a progress story, but monetary history suggests we're more like characters in a recurring play. The names and the technology change, but the plot remains the same. So, as you look at your portfolio or your bank balance, just remember the champagne of 1929. It tasted great right up until the moment the bottle broke. The music is still playing for now. Just make sure you know where the nearest exit is, and maybe don't buy the Ferrari on margin.